Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. The stock market is crashing, or that is the headline you see all over the place. We are down quite a bit in the last couple of months. If you're a tech investor, you've certainly experienced that. If you're a growth investor, you've certainly experienced that, at least in the short term. The reality is that the S&P 500, while down a little bit year to date, is still up in the last year. Even the NASDAQ, which is down 18% year to date, is still only down 4% in the last year. So we are reverting back to last year's prices, which, again, given some earnings growth, might be a surprise to some. But the reality is the marketplace is changing and the market is changing with it. As always, guys, this is just for fun. I am not a qualified financial advisor. Please make sure to do your own due diligence. But I thought it'd be interesting to look at the market and where we are in terms of pricing dynamics. Like I said, lots of turmoil. Netflix was a domino that fell recently. Basically, hey, earnings were kind of bad, and suddenly the stock is off 30%, and people are like, wow, what is going on? And that has spooked some investors, especially investors in even bigger, larger cap names. And the reality is that even though the S&P 500 is still up in the last year, even though the Nasdaq is only down 4%, Apple, Microsoft, Amazon, Facebook, uh, and some other stocks are reporting earnings this week, and those big names, Google is another one. Those big names make up 20% of the S&P 500. So if there is some slowdowns evidenced in their guidance or evidenced in their earnings, the S&P 500 might follow what's happened in the Nasdaq already, what's happened in some of these smaller tech names, because they've been held up by the power that is Apple. They've been held up by the power that is Microsoft. Some of these large cap names are seen as bigger safe havens from some of these small cap names which have suffered. But if there's a recession ahead of us, and certainly there's a possibility of a recession, inflation is up. The Fed has signaled that they're going to raise rates a couple of times this year. The market's already reacted to that. Some of that is probably priced in, but if inflation doesn't move to reflect those newer rates, if inflation continues growing, if people are struggling on Main Street because gas prices are high, because rent is high, because home prices have soared to ridiculous heights, and now that mortgage rates are in the 5+% range and growing quickly, you've moved from 2.75% to 5% in a matter of months. There is volatility everywhere, and the stock market is no different. You're going to see lower prices in crypto. You're going to see lower prices in the stock market. You're going to see lower prices all across the board simply because a recession is potentially looming and people are worried about that. Now, that doesn't mean that the recession is certainly going to come, but prices are coming down because people are worried about it. And what that means is that not only do earnings drop in a recession, some of these valuations that have soared start to get reset. And that's what you're seeing in the market right now. If you look at companies like Google, Google has seen a little bit of a drop as people start to prepare for their earnings. They're still up year to date. That's why people are worried about earnings. If earnings are bad, my 1 year returns could get wiped out. So year to date, you're down 17%. But if you invested a year ago, you're still up. And the reality is that Google is one of the better run companies in the marketplace. If you look at some of their financials, they're doing great. They grew really amazingly during the pandemic, but estimates are showing that, hey, they're going to continue growing at 17% this year, 15% the year after. And if there's a slowdown in that, some of these valuations start to get reset. And you're seeing some of that right now. Look at the free cash flow yield of a company like Google. A couple of months ago, you were getting 3 to 4% cash flow yield. Now you're at a high of almost 5%. Now, that's pretty good for what you're seeing in the market. I mean, you're getting 5% cash flow yield on a company like Google that's pretty consistent, whereas you can get a 10-year bond that's paying 3%. What's a better deal? Clearly, Google's a better deal. Even with inflation where it is, these guys are going to keep growing earnings in the long run. There might be some stumbles if there is a recession, but they're going to keep growing earnings in the long run. I'm liking Google at this price point. But again, 5% has happened before. And if there is a recession, some of these valuations may be reset. You've seen valuations explode over the last couple of years. And if you go back to 2013, 2012, this company was trading as high as 7 to 8%, right? And that's much higher than it is today. It doesn't mean that 5 weeks from now or 5 months from now, this is going to be a 7% free cash flow yield. But that's just something to ground you in what this company has been priced at in the past. When you're coming out of a recession, 2008 recession, valuations get reset. When things start to recover, the recovery may be slow. And this has been priced at a higher free cash flow yield than it is today. So it's not unreasonable that if something happens, it could go lower than where it is today. And I'm going to whip out an Excel spreadsheet for you. What happens in a recession is that not only do earnings slow, but valuations get reset. And that's what worries some people, right? If valuations start getting reset and earnings slow, you get that double whammy of what's happening in the marketplace. So let's open up a blank workbook so I can really show you what I mean. So let's say you've got a company that's got earnings and you've got PE ratios, right? So you've got earnings, let's say $1, $2, $10, $11, $12. And this is in 2019, 2020, 2021, and 2022. So this is a company that keeps growing earnings. And when a market is booming, PE ratios sometimes expand, right? So you get this price point where in 2019, you could have bought this stock at $150. 2020, it's suddenly $220, even though their earnings only grew about 10% because PE ratios expand. Now it's $264, and then suddenly in 2022, you're sitting at $325. So you've doubled your money, even though earnings only grew 30%, simply because PE ratios expanded. Now let's say 2023 sees a recession, and these earnings drop off a cliff. Well, PE ratios aren't going to stay at 25. They're going to maybe normalize back to 15 or even lower, and suddenly you've lost 60% of your money, right? That's kind of what you're seeing in the marketplace right now on a smaller scale. The earnings haven't started to drop yet, but PE ratios and valuations are starting to get reset. Now, if you combine that with dropping earnings in the future and further resetting of PE ratios, you could see further deterioration in the stock market. And Google's an example of that, but Shopify is another good example of that. This is a company that really exemplified what I showed a minute ago, where if you look at their price point, hey, these guys were $300 at the start of 2020. Suddenly they were up 400%, 300% in a matter of a year and a half. And now in the last year, they're down 67%. So if you're an investor that bought in the last year or a couple of months ago, you're like, holy crap. You may look at this and say, wow, what a deal. It was just $1,600 a few months ago, and suddenly it's $400. But again, it's $400. And now the earnings are slowing. They went from 85% growth, 57% growth. Now they're guiding to 31% growth. What happens if a recession comes along and their growth slows down even further? So price over sales is probably a good metric to look at with a company like Shopify that's growing. They were as high as 43x. Now they're down to 9.5x. Certainly a lot better than it was a couple of months ago if you believe in the company. And I think this is a very good company. I own their shares. I own shares of Google, by the way. This is the lowest it's been in a while. But again, go back to 2016, 2015. They've been as low as 4 to 5x, right? And this is kind of before these valuations started to go crazy. So is it possible that they get to 4 to 5x? Sure. That's kind of the reality of what the stock market shows you. It doesn't mean that today's prices are ridiculous. I mean, potentially this is the low, right? That's what's difficult with the stock market. That's why this channel is called Time in the Market, is because I'm a long-term investor. Timing the market is difficult because, hey, certainly this looks frothy. Certainly this looks frothy, but it kept going up, right? So people were like riding that high train, like, oh my Lord, we can't lose. And suddenly the reaction, the algorithms that are in there in the stock market, the automatic trading that happens these days, stocks go up really quickly and they fall really quickly. It's almost impossible to time these things based on how the market trades these days. If you look at 2008, if you look at 2000, sure, things fell, but it seemed like they fell slower, right? It took a while to get to that bottom. Now that bottom is boom, there it is. 20% drops in a matter of days. Which is what you've seen with Shopify, sorry. But again, these companies aren't bad companies. You can certainly find gems that are going to give you 10 to 20 to 30% returns 5 to 10 years from now on an annualized basis, even at today's prices. But you might have to suffer some pain along the way, right? That doesn't mean that Shopify is going to go back up to 1,600. Maybe it never does. But it does mean that maybe at $300, $400, if this this company finds a bottom, this is a very good compounder from here on out if the company can manage to do what they're doing. But again, there's more competition with Shopify. Like I said, there's slowing earnings. Amazon, for example, my wife was buying something in a store. Now there's a shop with Amazon button in stores, and they're trying to reach out to some of their partners to essentially set up their own storefronts that are kind of like Shopify Pay, that is mirroring what Shopify is doing. If there's competition coming into the business to commerce market, the consumer market that Shopify really excels in, this might struggle. And this is still, like I said, a a $50 billion enterprise value company that has maybe 2.3 billion in cash flow by 2026. So you're talking about 4 to 5% cash flow yield on a 26 basis when you can get that today from Google. So why is this a better investment than Google? That's something you have to ask yourself as an investor. Again, not a qualified financial advisor. Talk to a qualified financial advisor as you discuss these things. But that's kind of how I look at these stocks. NVDA is another good example. Hey, this thing is down. It's really grown in the last couple of years. Margins are getting better. How much of that growth is driven by cryptocurrency? If there is a recession, will cryptocurrency do well? Will it drop like a tank? Probably. I mean, all of these financial assets will probably drop quite drastically. You're even seeing some reductions in bonds, especially long-term bonds, as these rates rise. There aren't many safe havens right now. So you're seeing, hey, valuations of this stock are even falling. Let's look at their price over sales. Yeah, it's the lowest it's been in the last year or two. But if you go back to, 2018, 2020, whatever, you're talking a low of 2.6x. You're talking a mean of 12x. You're at a 14x right now. Certainly more room to drop, especially if there's a slowdown in earnings, especially if there's a slowdown in sales. Apple, big component of the S&P 500, another holding of mine, a key holding of mine. This is probably my biggest holding. Free cash flow yield, still solid at 4%. But when I was buying this, I bought this in 2016. I thought it was the biggest deal in the market at the time. You were getting 10 to 11% cash flow yield. Really amazing, really good buy at that point. Now I'm up 500% since then, but is a correction reasonable right now? Yeah, if there's a slowdown. If there was a recession, are people going to keep buying phones at the pace they're buying them right now? Probably not. There could be a slowdown in earnings. The thing that worries me is if you look at the S&P 500 and it being up where it is, people are kind of flooding into some of these safer names. And I totally agree that customer staples do well in a recession. They do much better in a recession than customer discretionary, than stocks that are dependent on discretionary spending. Tech, for example, is a big player in that space. But if you look at Costco, great company, shop there all the time. Did own some of these shares in the past, don't anymore. I just feel like Costco is one of those companies that's almost consistently overvalued for a reason. It's a safe haven. They're not going to go out of business. They keep growing at a decent clip. Same store sales are growing pretty well. But if you look at today's prices, you're paying 42x earnings, future earnings, when just, a year ago, 2 years ago, this was at 35x. 3 years ago, this was at 25x. And this is a company that's always traded in that 20 plus x range. But is 40x reasonable for a company like Costco? Maybe so. Maybe during a recession, they'll do better. Maybe they'll grow earnings at a faster clip because more people shop there. But again, maybe in a recession, while people still go to Costco, they're just going to buy some of the lower margin items. Not that Costco has a lot of high margin items. They kind of cap their margin at 15%. But if they stop buying TVs, if they stop buying as much, if revenue falls, if maybe some people cancel their Costco membership because they're shopping at Aldi and that $60 to $120 is just too much, maybe that impacts their revenue. Maybe their revenue starts slowing. Again, this is not a company that's going to go out of business. And most of these companies are not companies that are going to go out of business because they have a decent balance sheet. They still make money. They're free cash flow positive. We're talking about the cream of the crop here for the most part, maybe outside of Shopify. But that doesn't mean that a stock price can't drop 50%, even though it's a great company, because valuations matter. And the reality is what's happened in the last 2 to 3 years is that valuations have soared. And now valuations are correcting back to earth. And that impacts some of these riskier names more because you've already seen that. If you look at, let's say, the SPAC market and the high growth market or the DSPAC market, those companies have already fallen 50 to 60 to 70% in a matter of months. That's because their balance sheets are not as strong as Apple, as Google, as Costco, as NVIDIA. Their earnings are not as definable, they're not as consistent. So while these companies have held up, if the next week shows slowing in those earnings, maybe some of these companies will follow suit. And again, if Costco suddenly falls, if Apple suddenly falls, if Google suddenly falls a lot more than they have today, doesn't mean it's a bad company. It just means that valuations are normalizing for what the future really holds. If Apple comes out and says, hey, we expect earnings to actually not grow next year or even reduce because people are spending more money at the gas pump. If Google says, hey, companies aren't spending as much on ads because they are tightening hatches, because they are seeing cost pressure across the board, and now our growth isn't going to be 17%, it's going to be 0%. Do you think the valuations that are out there are reasonable? Maybe not, right? But if they say, hey, all things are looking good, we're still growing, we're still moving along, is Google at a 5% cash flow yield a good deal? Yeah. And I think I'm buying Google right now, despite the fact that it may fall further, but I have a big cash cushion to pick up any additional deals that may come across, right? And I like Google across other companies just because that free cash flow yield is really good. And that's what I look at these days when I compare other stocks. I'm like, hey, I can get 5% free cash flow yield on Google. Great company. They have a business. They have an AI business that might be worth a lot more in the future. That's really, all of these other bets have zero valuation on them. Their cloud business is growing. They have this ad business with YouTube and Google search that is amazing, cream of the crop. Other companies have already seen their shares drop quite a bit in the ad space. You look at Trade Desk, which might actually benefit from Netflix. You look at Facebook getting a big haircut in the last couple of years. Will Google follow suit? Who knows? But they are still going to be around 5 to 10 years from now. And at today's prices, I think that their long-term return is going to be good. So I'm not worried about buying, even if a year from now the stock is down 30 to 50%. Because is that realistic? Yeah, it could happen. Some of these valuations are at a point where even after the 10 to 20% haircut some of these companies have taken, they're still much higher than they were in 2016, 2017, 2018. And yeah, their earnings are much higher and their growth is much higher. But we also are potentially at a precipice of a market change, right? If inflation doesn't slow down, if people are pressured, if house prices suddenly start dropping because mortgage rates are 6% suddenly, if the Fed keeps raising rates, if they don't react quickly enough to a deteriorating market, job market, whatever, stock prices could drop. But I have cash on the side to account for that. And yeah, most of my portfolio is still invested, and really most of my portfolio is in the S&P 500 and other index funds. So if those drop 20 to 30%, most of my portfolio will drop 20 to 30%. But that is the reality of long-term investing, right? We've had a very good, very easy market up until 2021, 2022. Even 2020 during the pandemic looked really bad for a while. It was like 2 months, and then suddenly it's like, woo, it's a rocket ship. We're making a ton of money. And even for me, even if you look at my growth portfolio, even though I'm down like 30% in the last couple of months, I'm still up because most of the purchases were before 2020 and during 2020. And I haven't been buying much since these valuations soared to ridiculous heights, right? If you look at Shopify 40X, it's like, holy crap, these guys have to execute perfectly. And they already have it, right? And most of these companies that are at 30x sales, 40x sales, they're going to have stumbles along the way. And those stumbles are going to be punished severely with a massive valuation cut. And even big companies will have stumbles along the way. And if they're priced for perfection, if they're priced at 40x, 50x earnings, and if there's a stumble, there's going to be a valuation haircut. And if there's a recession, there's going to be a valuation haircut across the board. The S&P 500 right now has a Shiller P of like 30x plus. Historically, that's been in the 20x post 2020 when tech started to become a bigger player, when valuations went up simply because of lower yields. And yields are still probably going to stay low. You know, if yields remain at 2 to 3%, the stock market should still kind of be in that 20x plus range. But if inflation is a bigger problem, if it's a runaway inflation issue and the Fed has to keep raising rates and suddenly it's 4 to 5 to 6 to 7%, not saying that that's going to happen, that's very unlikely. maybe it's back to 15x multiples, and that's a 50% haircut from today. So that's a possibility. That's all I'm saying. That's what you have to be aware of as an investor, that, hey, not only will earnings slow during a recession, but multiples will get cut. However, the reverse could happen too. Inflation could just kind of die down. The Fed could say, hey, we're seeing a slowdown in the market. We're going to stop raising rates. We're going to lower them suddenly. And the 7 raises that the market has already priced in, that is continuing to price in, maybe there'll be a quick recovery. Maybe it'll be like 2020, where the stock market fell really quickly, really severely, and people were like, holy crap. But then it recovered really quickly. Who knows, right? That's the reality of the market. No one can time it perfectly. People will miss. That's why I just buy and hold for the long term. I do sell from time to time in some of my active names, because stocks, individual stocks, some may never recover. The index will always recover. If the S&P 500 is at 4,200 today, and if it drops to 2,500 in a year, I believe that 5 years from now, it'll be above 4,200. Or 10 years from now, it'll be above 4,200. It will eventually get there. There will be a recovery, and I'll keep buying all the way down. However, individual stocks, if Shopify is at 1,600 and it drops to 200, it's possible that it never gets back to 1,600. That's just the truth with individual stocks. There's some individual stocks, and I'm not saying it's Shopify, there's some individual stocks that will never, ever reach the heights they've hit in 2020, 2021, and 2022. That's just reality. That's just how the stock market works. That's why picking individual stocks is difficult, because not only do you have to time the entry right, sometimes you have to time the exit right. Unless you're buying big cap names like certain individual stocks, I believe they will always recover to where they were, but some of these smaller cap names, they won't. So that's the stock market today. Again, what happens from now, nobody can tell you that. I just wanted to let you know my thoughts on some of these bigger names, on some of these stocks, valuations, and where they are and what might happen in the future. Not a qualified financial advisor. I will always repeat that. I'm just doing this stuff for fun. Do your own due diligence, guys. Talk to a qualified financial advisor, but be aware of the risks you're taking when you're investing, right? It's been an easy ride for a while, and it's getting more turbulent. So be aware of the risks you're taking. Be aware of the companies you're buying. I think for the most part, most investors, and even myself, buying an index fund is just the easiest way to do it. Even professionals have trouble keeping up with the index across a multitude of years. People like ARK funds, they'll have years where they do 150%. And it's like, wow, these guys can't miss. What an amazing company. But then suddenly you buy in because the hype is there and you're down 70% from the highs. And in the long run, that happens to a lot of people. Individual fund managers get hot. They have a great couple of years, and then they trail off and disappear, and they do whatever. They make their money, move along, etc. But you're the one that suffers because you're buying at unreasonable valuations. And if you buy the index, you're just buying every company in the stock market, and that has 100+ years of history behind it, and it will eventually recover. That's just how things work. Maybe these valuations are unreasonable, untenable. Maybe things will really go back down to earth, and we'll have another 2000 to 2010 area where if you were in tech stocks in 99 and 2000, it took quite a while to recover. I mean, if you look at the Microsoft chart, it was quite ugly until the last couple of years. Maybe that happens again for some of these companies, that, hey, there's just low to negative returns for a couple of years, and you have to suffer through the pain before you get back to growth and reasonable valuations again. Or maybe we recover tomorrow and today is the bottom and things keep going. The reality is nobody really knows. So keep an eye on your own investment. Be aware of what the stock market brings, the risks that it brings. We are in a unprecedented time where low yield, high inflation, high valuations across the board, assets in every which way, whether it's stocks, crypto, bonds, baseball cards, NFTs, whatever. Everything's expensive. Cash is losing value. It's a difficult market to be an investor in, but it's also one where values will come down and returns on a future basis will get better. If I'm buying Google today after it's dropped 20% from the peak of last year, and earnings continue to grow, I'm getting a better value than I was 6 months ago. And that's the truth with a lot of these companies. You are going to start seeing some cash flow yields that start getting into that Apple 2016 range where it's a good company with good long-term prospects, and suddenly you're getting 7 to 8 to 9 to 10% free cash flow yield against a bond that's still paying a couple percent and never going to grow. Whereas earnings will eventually continue to grow, and that cash flow yield, even if it drops temporarily, if there is a recession, will eventually recover, and you'll do well, and you'll have really good returns in the long run. And that's the key word, the long run. Long-term investors will win. Short-term investors are suffering right now. And long-term investors are certainly suffering, but if you have a long-term mindset, that suffering will win out in the end. It's just tough to stick through that, especially if you have economic troubles in addition to that, right? If people start losing their jobs, suddenly they may have to sell when they don't want to sell. That's why it's important to keep an emergency fund. That's why it's important to have a cash cushion and ride through the down times and eventually emerge on the back end. And right now, it's certainly painful, but it could get even more painful. Who knows? Who knows what happens in the future? Some of these valuations are still pretty high, even after what we've seen in the last couple of months. If you're just purely in tech, you might not think that, but some of these other industries haven't been hit that much. And maybe they will be. Who knows? It's a tough market. It's an interesting market, though, and I'll keep making videos. I'll keep showing you guys companies that I think are becoming good values, because I think there's more and more good values emerging. And they will in the future. I've made some videos in the past, and I think those companies are probably trading lower now than they were then. And maybe I like them even more. For example, Genius Sports, I've bought some recently, and I think it's going lower. That's the reality in this market. That company's not making money yet, but I think 5 years from now, today's prices are going to be interesting. But Google is also a better bet. So I'm also buying Google in a bigger way. And if their earnings are a disappointment, I'll probably keep buying because I like the company. So let me know what you guys think. Thanks for watching. Have a good day. Best of luck in the market. Keep your head up. Keep a long-term mindset, and hopefully we will all do well. Guys, thanks for watching. As always, keep watching. Hit that like and subscribe button, as they say on YouTube. I don't think I say that enough. I am not a qualified financial advisor. Just a reminder, guys, do your own due diligence and make sure to talk to a qualified financial advisor before investing. I'm just doing this for fun. And thanks for watching. Let me know what you guys think. Let me know what you guys think about the market. Thanks.